Let me ask you a question. If you had a friend who always repaid you on time, but then discovered he had borrowed from hundreds of others while maintaining perfect repayment records, would you keep lending to him? This is exactly the dilemma facing global investors today with U.S. Treasury bonds. With America's debt reaching a staggering $36 trillion, equivalent to 125% of its GDP, the market is now seriously questioning Washington's ability to honor its obligations. The recent downgrade of U.S. credit ratings by all three major agencies has only amplified these concerns. Hi everyone, I'm Lily, your resident Wall Street rebel with a knack for calling out the market's BS. As we speak, the U.S. Treasury is conducting an auction for $16 billion in 20-year bonds, the first major long-term debt sale since Moody's downgrade. The results, to be announced Wednesday afternoon Eastern Time, will directly impact Treasury yields and ripple through global markets. Here's what you need to understand. The 10-year Treasury yield currently stands at 4.48%, while 20-year and 30-year yields are approaching 5%. Remember this fundamental principle. Bond yields move inversely to prices. Higher yields mean lower prices, which indicates more sellers than buyers. In simple terms, rising yields signal growing market anxiety about U.S. debt. In June, there is about to expire $6.5 trillion of U.S. bonds, and the repayment mechanism of U.S. Treasury bonds mainly covers the previous arrears through borrowing new to repay the old, and it is necessary to issue more than $6.8 trillion U.S. bonds to cover this part of the mature debt. So every auction of U.S. bonds has attracted the attention of market traders and investors. If the auction situation exceeds expectations, the repayment pressure of U.S. bonds can be reduced, and if it is not as expected, it will increase the market's worries about the repayment ability of U.S. bonds. To put these numbers in perspective, America's debt-to-GDP ratio of 125% means the country owes 125 for every 125 for every 100 it produces. Compare this to China's 105% ratio, or the fact that China's 10-year bond yields are just 1.65% versus America's 4.45%. The math is brutal. America is borrowing more than others while paying significantly higher interest rates. Now let me share a perspective that might surprise you. The US dollar is essentially US debt, and US debt is the dollar. This is how the magic works. The Treasury issues bonds, which the Federal Reserve then monetizes by creating new dollars. It's a self-reinforcing cycle that has underpinned dollar hegemony since World War II. This system allows America to cash in its future earnings today.